Hey everybody, this is Richard. So it's the third week of April and I'm doing the performance review today. So I wanted to first do the disclaimer, then I'm going to look at the April results for the Phoenix from the 17th of April through the 23rd. We're going to look at the Wave, Swing, Crusher, and Pro as well. So I'll briefly discuss how those handled this last week. And then at the end, this will be a little bit longer video because I'm going to be doing an analysis of one of the algorithms and kind of showing people kind of why the algorithms do specific things that they do with regard to stops and profit taking. And then I'm also just going to discuss some of the emotions of trading. So with that out of the way, let's go ahead and look at the disclaimer. So feel free to pause this if you need to. This is our standard disclaimer. Just remember, trading futures involves substantial risk of loss. It's not appropriate for everyone. There's and definitely pause this. You can read this entire disclaimer, but my company, we're not a CTA. I'm not a commodity trading advisor. We're a third-party developer, and the algorithms are traded under what's called a letter of direction. But just remember that there's risk of loss with futures, and that the past performance is not indicative of future performance. Okay, so as I've been doing, I've been giving the algorithm a grade at the end of every week for the review, just to give a high-level view of how it did. But I gave it a B+ this week. The main reason why is because it actually did a pretty good job. The algorithms were positive by almost 2.5% for the week. That's about $489 per unit traded. The reason why I didn't give it an A though was because of yesterday. We got kind of whipped around with one of the trades, and I'm going to talk a lot more detail about that trade towards the close of this review. So if you want to kind of see the analysis that I did, then you definitely want to watch this complete video, because like I said, at the end I'll be going into more detail on the last couple days. But we closed up by about almost 2.5%. Now it doesn't feel like it, but the S&P actually was pretty much break even for the week. It actually closed down a little bit on the weekly chart that I was looking at. So the week actually was down on the S&P, and we actually closed up. So that's actually a win for us, even though in trading, and I'm going to talk about the emotions of trading towards the end, but you never really feel like you had an amazing day when you trade. It's very rare that you just feel like everything just went perfectly according to plan. The reason why is you always leave some on the table. You're never going to buy the exact low and sell the exact top. But I do feel that it'd be disingenuous if I gave us an A, given that we were up quite a bit yesterday, and then the market sold off towards the close yesterday, and then we ended up getting out with a small gain today. So it was still a win, but for sure, the feeling, I just feel B+ is a little bit more in order. So I'll go ahead and look at it a little closer though. So let me go ahead and pull up the TradeStation screen, and we'll look at each algorithm a little bit closer. Okay, so first, here is a weekly chart of the S&P 500. I wanted to show this just so you could kind of see what I mean. So last week, the S&P closed at about closed at 4,176, and as of right now, it's at about 4,167. So it's pretty much flat, but technically the S&P closed down for the week. That's important because it helps remind us of sort of the context in which we had the kind of 2.4% gain. That was in the midst of a S&P that actually was relatively bearish, especially the first few days of the week. But it did rebound pretty strongly. So, again, it doesn't feel like it was down, even though really it was. But let me go ahead and get rid of this weekly chart though, and let's look at each algorithm individually. So I'll start with the day trade. A lot of times this one is the easier one to do, mainly because it doesn't always trade. So again, we haven't had a trade this week on this algorithm either. So this is kind of the last week. So here's the 19th. This would be Monday, Tuesday, Wednesday, Thursday, Friday. And again, this doesn't show any trades because we didn't have any. And the week before we didn't either. So the last trade we had was actually way back on the 5th of April for the day trade algorithm, that is. So this algorithm didn't do a lot, so it's kind of easy to talk about. The other algo, though, that we recently got back into on a trade is the 10-year note algo. That's this one here. And again, if you saw the previous video, you saw that we bought on the 14th of April. We held on to it the 15th, the 16th, and then the 19th. Notice how where the week closed on the 16th, where the 10-year was, and we're actually up a little bit on that. Again, the market, it has about another 30 minutes to trade before it closes for the week. But right now it looks like it's just up slightly. But again, not a lot has happened here. The target has moved around a little bit. In other words, it doesn't look like anything's been going on. But we bought back here and we're still in this trade. So it is still profitable, and so that's a good trade for us. But let's look at this chart. This is the one that's a little more interesting. This is the momentum S&P algorithm that the Phoenix trades. Now, what I want to point out is a couple things. First off, just again, to give you your bearing, the 15th was Thursday, the 16th was Friday, so this is Friday, and then right here is Monday. So we got Monday, Tuesday, Wednesday, Thursday, and then Friday again. So this is the last week. Notice how the S&P traded lower for a couple days, and then it went kind of higher for a couple days. And then you had this kind of weird Thursday where it sold off, and then of course it rebounded strongly here. But what I want to point out is that we really had two trades. We had this trade right here that we got into on the 19th towards the close, and we hit our target pretty quickly, so it got out. And notice how that was a great trade for us, because it got in and got out within, I think it was about 10 minutes is all that we were in. And then the next day the market gapped lower and sold off. So obviously it did the right thing by getting in and getting out. Because what you'll notice with these algos is that sometimes they get in and stay in, sometimes they get in and get out immediately. The next day, so this is where it gets a little more interesting though. And also real quick while I'm on, notice how we didn't buy on this Friday. Again, that's one of the changes that was made about a year ago to minimize the over the weekend risk, is we don't rebuy on a Friday. And it turned out that was a good move here, because the market gapped lower on the Monday morning, and we would have been stopped out of that trade as well. So again, it did the right thing on Friday, did the right thing on Monday. Tuesday, it did the right thing as well. It bought, and then the market sold off in that final hour, but then it didn't sell off enough though to get stopped out, so it stayed in. The next day, this is the 21st now, Wednesday, the market gapped lower. We actually came fairly close to being stopped out, but it wasn't stopped out, but we were still in the trade. And what you'll see here in this is that the S&P rallied real strongly. The entire, pretty much all day Wednesday, the market was just taking off on fire. Now, a lot of people ask me why it didn't get out when we had this really big gain. And when I'm done with this part of the video, I'm going to be showing you some of the different ways that this algorithm, if it was changed to get out when you had a certain gain on a day like we had on Wednesday, what that would do to the algorithm in the long run. So I'm going to spend a lot of time on that at the end of this video, so stay tuned for that. But basically, we got in, we stayed in, so it did the right thing here. But notice on this day, the market really sold off, and that was primarily due to an announcement by, I'm not sure, I think it was just a report of an increase in capital gains, and that really caused the market to sell off. Before that, it was actually up a decent amount. So that was kind of painful for us to see those gains go away. But then what you'll see here is that we did end up getting out today, this morning. And then, of course, we got out and the market did rally. So that, it never, again, I gave it a B+ because I feel like an A just wouldn't be fair given the emotional swing that we all had in this part. But that's one reason why I wanted to remind everyone that, the week actually was down on the S&P. And so the fact that we were able to pull out some gains actually is good. And again, it never feels like you have a great win when you're a trader. I mean, a lot of times it'll feel about like it does now, but when you look back, we did close out this week with another gain. So that's the third week in a row, and April at this point is looking really strong for us. But I think that covers this algorithm. Now, again, I want to mention, I'm talking about the Phoenix right now, but if you're on the swing trader, then you saw these exact same trades actually. So anyone that's on the swing trader, they should be up about 2.4% as well, because there were no day trades, and that's That's the thing that makes the Phoenix different than the swing traders, that the Phoenix has the Phoenix day trade. Now, if you're on the wave trader, then you would have seen this trade right here, and I'll have to look to see if it had any other ones. So, but it did have this winning trade, and then I believe it would have had one this morning as well. So I think it ended up being about the same as this one, only without some of the volatility that we saw. And if you're on the crusher or the pro trader, so if you're on the crusher, then you would have seen pretty much the same dollar return as the swing and the wave, about the $480, I think it was. But on a percent basis, that's smaller because it trades on a 30K unit size. And then if you're on the pro trader, then similar thing, you would have made a little bit more on the extra S&P trades that would have also been winners, but only by a couple $100. And so it wouldn't have been a massive amount. And since that trades on 30K increments, on a percent basis, it actually would have underperformed compared to the swing and the Phoenix. So for all the 5 algorithms, the main algos that people are trading, the Phoenix and the swing are the ones that did the best this week. And that was primarily due to the 2 winning trades that we had on the S&P. And then the 10-year is up just a little bit for the week from where it was last week as well. So with that out of the way, I want to now jump in and talk in more detail about this trade. Okay, so as a reminder, this is what we did. We B plus 2.39%, $479 per unit traded. But let's go ahead and go to the next slide, and I want to talk in more detail about this trade that we had on Tuesday. So Tuesday, basically what happened was we bought at the close like we normally do. Wednesday, everything was looking great. This trade was up quite a bit. But notice how it didn't get out. Where if you look at at the other days, it got out on this Monday and it got out the next day on this Thursday over here. And if I were to pull up a chart of the S&P with the algorithm on it, you'll see at least half the time when we get in, it gets out when it hits this 4-point target pretty quickly. One thing that makes these algorithms a little, in my opinion, special is that they're generally speaking, they can be very good at identifying when it should get in and hold versus when it should get in and get out pretty quickly. The problem is that a lot of times we will have these little gains like you see here, and what people don't realize is that the algorithm did the right thing on these. We had a nice little gain, but people don't really think about it too long to consider that that the algorithm could have held, and if it would have held, it would have lost the gains that it had. So the fact that it got in and got out, it did the exact right thing on Friday and also Monday. And throughout the last few weeks, I could show you many cases where we bought and got out and then the market sold off the next day. So it's also helpful for us to kind of recognize some of the positive as well. But I do want to be honest about the algorithm. I don't want to just inflate it with stuff that's not accurate or that heavily leans towards a positive side on it. But when we evaluate them, I have to show you kind of the context of a lot of this stuff. So let's look at this Tuesday trade now. First thing I want to point out is notice how it didn't get stopped out. So what does that it tells us that the stop did a good job, that it didn't trigger when in other words, we didn't get whipped out of this trade, didn't get stopped only to see it rally. Now that'll happen on occasion, but in this case it didn't. The next thing I want to point out is notice how it held this entire Wednesday as opposed to getting out when it had a 4-point target. Because remember, half the time it'll have the 4-point target. So it really did do the right thing there as well. It got in and it held that entire day, taking advantage of this big run up. And this was a really big gain for us, or it would have been. And I know it's tough to see this roll over the next day like it did, which is why I'm trying to go into more detail in this video on some of the mechanics of it. But notice then on Thursday, it opened about where it closed the previous day. It actually rallied and it was actually up even more. And then some news came out late in the day regarding capital gains tax that forced the market to sell off. And so it sold off, and we actually came close to getting stopped out, but it didn't. But then the next day, on Friday, that's today, that's when it did get out. So it got out at the open. And that's because on Fridays, we do what we can to get out so that there's no overnight risk. And again, this is all the algorithms. It's not anything that I do. It's just what the algorithms do on their own. But so the question, though, that I get, and it's a very valid question, and so I thought it'd be fun to kind of look at it in depth, is why is it, though, that like, why not just get out when you have a $500 gain, maybe a $1,000 gain, maybe a $3,000? Like, at some point, shouldn't we just get out and be happy with it? Now, the nice thing about quantitative trading is it doesn't have to be a mystery. I mean, I can actually write in the code that it would do that and show you what the long-term results are, and that's actually what I'm going to show you. But that's not the only thing. You could look and say, well, why not always do a 4-point gain? It seems like maybe in the long run that might do better. That's this first one. The second one, why not get out when you don't have the short target, and you, instead of holding all day, why not get out when it hits $1,000 gain? That's a monster trade. I mean, that's a 5% gain on a 20K account. Why not just take that and be happy? And then the other one that I get a lot is why not do some kind of break-even trade? Now, we didn't get stopped out of this trade, but I guarantee if we would have, then I would have had a lot of people email me saying, how come you let a winner turn into a loser? Which I agree. I mean, that's not easy, but I want to also just show why we don't do the move to break even as well. So like the way that would work is it's a trailing stop. So maybe you'd say something like, okay, once you have a $500 gain, once it reached up here somewhere, then you would move the stop to break even, so that if it does sell off, you would just kind of walk away as if the trade didn't happen, as opposed to with a loss. It's a very good point, a very good question, and we're going to look at that. And then the final one would be, why not, instead of break even, move the stop to like a 50% stop? So what that means is, again, once you have a certain dollar amount gain, you can adjust, why not move the stop to protect half of the gains that we have, so that here, when you look at this chart, and if it's up 2,000, what that stop would try to do is prevent us from losing more than 1,000 on it. So half of the 2,000 would be 1,000. That's when it would get stopped out. So those are the different things that I looked at in this video, and I mean, this is the stuff that is incredibly interesting to me. So I hope it is for you as well. And if you've been wondering why we don't do any of those things, I'm going to go into detail now on why that is, and show you the reports and talk through why that is. So let me go ahead and go to the next slide now. Okay, so the first thing I want to look at is why not do where every time we get in, we just always have a 4-point target. Now that one is the easiest one for me to kind of show why we don't. And the reason why is because of these kind of trades. Now this is a trade that we would have had back on the 1st of February, where it would have bought on the 1st of February, and it would have held that entire basically 3 days, and had a monster win on that trade. If we had a 4-point target, it would have gotten out right in here with a pretty nice gain still, but then it would have jumped right back in here, probably would have gotten out with a nice 4-point gain here, it would have gotten back in here, another 4-point gain. So it would have had some gains there, but none of them would have equated to the massive gain that you see by holding. And so then you might say, well, why not just always hold for a long time? Well, the reason why is because it doesn't always work that way, though. There's times where it won't, and it goes sideways like here, and you want to be able to get in and out, in and out. And again, the algorithm does this automatically. It's nothing that I do. I don't look at it and say, oh, today I think it's going to just go sideways, so we're going to get out. I mean, the algorithm, it's looking at technical indicators and a few different things to make that judgment call. But when I change the code to be always at a 4-point target, the performance is half. So instead of being up about 105,000 in the back test all the way back to 01, it's only up about 60K. So it really does cut the profits in half. So that's an easy one for me to say. It just doesn't make sense. I mean, you do want to there are times when you want to get in and hold. In fact, that's what makes this algorithm profitable in the long run, I think, is that every once in a while you will have these gains where it just really blows everything away. Now, in this case, it didn't work out quite that way. I mean, it looked like we were up a lot. We were, but then it sold off, and then we got out today. So we still had a win, but it was up more. So I know it doesn't feel like a win. So, again, I don't want to, say, hey, everything's fine. We get an A+, because I realize the emotional impact that a trade like this can have. And I just want to be realistic about it. So, but yeah, with that out of the way, let's now look at some of the other cases that are a little bit more, I would say, possibilities to consider is probably a good way to put it. So let me go ahead and go to this slide, and I'll show you what I mean. All right, so the first case that I wanted to look at was why not have some gain where, fine, it's not a $200 gain, but whenever that condition hits that you say that we should hold for the entire day, instead of holding the entire day, why not just have a really big target? Now, the way it is right now, the current implementation, we just have a high target. It's basically, in essence, infinite. So when that happens, we just stay in no matter what. There's no target that's put out. It just holds until the next candle, and then it reevaluates. That's another way of saying that it just has a target that's the highest you can be, which is none. But what would happen if you had a $500 target? Now, hopefully you can see this okay, but what this chart shows is that exact thing, how that trade would have worked out. So notice how we would have gotten in right here on that the same time. Same stop, so it wouldn't have been stopped out. You would have gapped down, eventually would have traded up, and we would have had a $500 gain. But what's easy to miss is that if we were to do that, we would have gotten right back in at the close, and then we would have got stopped out actually yesterday because it wouldn't have rallied enough to hit the 500 target again, and so we just would have got stopped out. Then we would have gotten out yesterday morning and got out with a small gain like we did this morning. But I guess what I'm trying to say is that when you make a change to a quantitative system like this, if you're just looking at a chart, you kind of forget that there's all these other effects of making a change like that. Namely, if you get out early, that means that you're going to have more trades. And if the algorithm thinks that there's enough juice for the market to go higher, why not just stay in? I mean, why would you get out knowing that you're probably going to buy at a higher point and then kind of risk that? And so that's where it gets really tricky. But fortunately, we can let the numbers decide, at least in these cases. So that's what this high target is down here. So if you look at the Excel down here, the snippet, what I'm showing is what the current back tested is going all the way back to 2001. This algorithm in the current implementation has made 105,000 in the back test. It's got a profit factor of 1.29. It's had 1,710 trades. The average gain per trade, that's winner and loser, not winner, but the winner and losses, all of them averaged together. It's about $62 per trade. And then the drawdown is about $12,000 on that, and it's got a 77% win rate. So that's our baseline. That's what we are right now at this point. If we did a high target of 500, notice how the performance drops by actually a decent amount. I mean, that's a significant difference. 80,000, the profit factor goes down to 1.2. Notice how you have more trades though, and that makes sense, right? If you get out, then you're going to have more of these kind of cases. The average gain is now $41. That's a massive difference, and then the drawdown is even bigger. So it loses more in the long run. And I think, and that's counterintuitive. You might think, well, why would it do that though? Because now it's getting out when it has a $500 gain as opposed to staying in on those cases. Well, what that tells you is that instead of getting out with a $500 gain, that's not the thing causing the drawdown. When those events happen, those are actually really bullish conditions, which is why we stay in them right now. But then you might say, well, okay, 500 is too small. Why not 1,000 though? And notice how it improves a little bit. If you go to 1,000, that's this one up here, the top right. Now, instead of getting out in the middle of this candle, it's a little bit towards the top again. So now you would have had $1,000 gain on that trade. You still would have got stopped out on this one, and then you still would have had the same trade here. So it would have been a little bit better for sure in this week at least. But when you look at in the long run how it does, notice how the performance is still worse than where we're at right now. You're at 92,000, prop factor 1.24, number of trades 1,800, $51. The drawdown is a little bit bigger. So then the final thing you might say is like, okay, well, why not do 3,000 then? If 500 doesn't work, if 1,000 doesn't work, but clearly it's getting better, notice how it goes 79 to 92. What happens if you go to 3,000? Well, what happens is it's true that the performance does improve. It goes from 92, it jumps up to 110, and notice where we're at right now is the 105. So of all the things I've talked about so far, that bottom line would be the most convincing potential change if we were to make a change, would be to throw in a target of about $3,000. But notice in this case, it wouldn't have helped because we didn't hit that target. I think this was about a $2,000 target. And you might say, well, why not do 2,000? Well, if you do that, though, you really run the error of potentially curve fitting. In other words, you're just seeing what worked and then applying that. And it's not a great way to make modifications to an algorithm, especially one that generally speaking has done really well. You know, especially if you don't include the bull put spreads, then it has to be pretty compelling to actually make a change. But so the summary, though, and we're going to look at the other ones too now, but the conclusion is that as the high target increases, the positives are the total gain increases. You have a decrease in the total number of trades, which is positive because that's time in market is reduced a bit, which is good because it's less kind of risk overall. The average gain per trade increases, which gives you more margin built in. And then the drawdown actually decreases as well. There's a notice how it goes from 13.5. It does blip up a little bit here to 13.9, but then it goes to 12K, and then it kind of stays at that. So the main negatives of a higher target, though, are that the win rate does decrease a bit, and then there's more volatility in the account. What I mean by that is one negative of having a really high target is exactly why I'm doing this video right now. You'll have days where it's up a lot, then down a lot, and it just can drive you crazy. And there's something there. So in other words, even if these numbers are the same, you know, we have to consider kind of the emotional win as well. So the conclusion from at least this is that the higher the target, the better. Now, you might say, well, not really. Isn't it just saying 3,000 is better? But the point, though, is not to find some like curve-fitted number that happens to do really well, but to figure out what the trend is. And in this case, the trend is the higher the target, the better the algorithm does. So all we're doing right now is we're taking that to the logical conclusion, which would be instead of having a target of 3,000, why not 4,000? Why not 5,000? You hit a point where the target is 10,000, and it's never going to hit that. So you basically don't have a target. For those cases, at least. That doesn't mean we get in, we stay in forever. It just means that when these conditions are present, we don't get out early. I'm going to talk more about that again at the end of this video. I'm going to have another thing where I do an optimization, but let's look at the other cases as well. The kind of the break-even stop is kind of the next one. Okay, so now what we're going to look at is instead of having a high target, though, fine. If the data says that it's best to just kind of let it run, and the bigger the target, the better. Meaning, you know, basically not having a target seems to be ideal. Then the next question would be, well, maybe one way to minimize some of the fluctuations is to add some kind of a trailing stop, and in this case, just a stop that would go to break even. So in other words, once the account is up a certain amount or the trade is up, then the stop would move to the break-even point. And that's what you see here. Now notice, though, that what I realized pretty quickly, and I've done these analysis before, but not in this format, and I haven't done it recently in the last year probably. But what you start seeing pretty quickly is that it doesn't work. I mean, if the current is 105K, 1.29 profit factor, $61 is the average gain when you factor in the losses and the winners and average them together. The current's 105K, and that's this top one up here that we already looked at it. But the other ones, they just don't even come close. So at least the high target got a little bit better, and it actually got sort of maybe even compelling that, well, maybe there is something magical about a $3,000 target. But in this case, with the break-even stop, there's really no case where it makes sense. I mean, if you get into the trade and you have the normal stop, and then once you have a $500 gain, what this second line does in this bottom left chart here is it basically moves the stop to break even once you have a $500 gain. So at this point, once the account hit kind of right in here on that candle, the stop would have moved to break even. And you can actually see that then the next day when it sold off, we actually would have got stopped out at about break even. It's actually like maybe a tick or two above the entry. But notice how that's how that works. So you can see it in the chart that it did what it was supposed to do. Now, if this would have kept selling off and we got stopped out, then that would have been the thing that everyone, including myself, would have been questioning, like, why don't we do a break-even stop once you're up a decent amount, to protect us from kind of going crazy and being up and then down. And again, I just want to remind everyone that this trade did end up being a winner, by the way, today. Just, we left a lot on the table, obviously, and it certainly didn't feel like a great day. But in this trade, the reason why we don't go to break even is because it doesn't work out as well. But then you might say, well, maybe what you do then is you wait for it to have a $1,000 gain, and then you move it to break even. So that's what this top right one does. And so up in here is where it would have moved it. And in this trade, it wouldn't have mattered much, because it already, the same thing would have happened. It would have just moved this stop later. But if this candle had a lot of up and down movement, it might have mattered more. And then the final one that I did just to close it out was, well, let me just double check. Let's do $1,500 and then move to break even. And same thing. The performance it's a significant difference. I mean, it's almost a 10% difference in the total gain. And this is on the edge of being statistical noise, but the fact that all three of these are under the current tells you that it's not as good to do. And notice how the drawdown doesn't really change either. The win rate goes up just a fraction, and that kind of makes sense because when you get the breakout or the break-even stop, that actually technically is a win because it's a couple ticks above the entry. But pretty clear that having a break-even stop doesn't really help either. The only thing it helps, and that's what I try to capture here, is certainly there's an emotional factor that isn't accounted for in these numbers, namely that once we're in a trade and it's up a lot, it just kind of feels good to have a stop move to break even. So okay, this won't turn into a loser. But as far as the numbers go, the difference is enough that in my mind I would say moving to break even doesn't make sense. Now the final one that we'll look at, though, that one is a little more compelling, and we'll look at that one closer as well. But that's instead of having a break even stop, you do a 50% trailing stop, and you can already see in the chart how that seems to maybe have some room to run on that. But what you find, and it happens all the time in trading, is that it's true that you fix one issue, but then you just really create another issue, and that's I think what these numbers show down here. Because notice how even with this, we still don't beat what we have now. But just for consistency, let's talk about them. So really what this one does, again, this is our current with no trailing stop. We get in and it either gets out when the stop is hit, the normal stop, or when the target is hit. And then there's days where it won't have a target to try to capture the bigger moves. But if you, in this case, the bottom left, all we're doing is we're saying once it's up $500, we move the trailing stop to 50%. So the stop goes from about a 17-point stop to a 50% stop when it's up 500. So in this case, once it would have hit 500, up 500, the stop would have moved to about $250 above our entry. In other words, what we're saying is we're up $500. We don't want to risk. We're only willing to risk half of what we're up, and then it trails higher as the market goes on. But what you see here is that notice how it got out in the middle of the day. That's the kind of thing that's kind of hidden. What that means is that during that day, that was Wednesday, the market opened lower, it rallied, it hit that 500 kind of initial point, and then it moved the stop to $250 below that. And what that means is that there was enough volatility in that move higher that it actually hit that stop in the middle of the day. And so it got out with a $250 gain, more than likely on that day. And notice here the total gain, 97,000. You have more trades, which makes sense because just right here you see an extra 2 trades because you get out earlier, so it means you get in. So that means that we would have been stopped out on this trade and then had a small gain on this one. The drawdown on this one, though, is actually substantially higher. And I think the reason behind that is mainly because these extra trades that it has happen to be bad times to be long. In other words, there's something about the one day that you're in and you stay in, which again is why we do it. But the other 2 cases that I looked at is I wanted to see what if we do it at $1,000 though. That's this one right here. And notice this one works out more like everyone probably would have envisioned it. Like you get in, you have a big day, it sells off a bit, and then you get out with a really nice gain because you're only risking half of your profits as opposed to all of them with the break even. So in that case, it would have worked out really well. You would have had kind of the same thing if we would have had a $1,500 trigger point. But again, when you look here, notice how all 3 of these are slightly worse than what our current is. And I think that's the main reason why it's not, in my opinion, compelling enough to make the changes because it's not better than this. In my opinion, it needs to be better than that by some sort of magnitude. I mean, it's true that if all things are equal, then you should go with the one that's kind of less stressful to trade, which for sure would be the one that has a trailing stop. But with an algorithm like this that hasn't been touched in a year as far as any changes to it, you just have to be so careful to make a change. And that's one reason why this at least right now, in my opinion, wouldn't be enough to warrant some kind of change. So there's definitely fluctuations, but there's no strong pattern. In other words, the $1,000, it went from 97K to 103K, but then you go up a little bit higher and it goes to 102K. So it's not like the high target one that we looked at, where you just see the very strong correlation between a higher target being better for the returns. All right, so here's a summary now of all the different things that we looked at. So again, here's the current at the top, and notice how when you always have that 4-point target, the performance drops. I mean that it's just crazy how bad it gets. So definitely you don't want to do that, or we wouldn't do that. But then when we start messing a bit with the high target, you do see initially it doesn't work out well if it's 500, but then you go to 1,000, it gets better, and then you go to 3,000, it gets even better. And so that's that correlation where you see it definitely getting better the higher the target is. And then here's with the break-even trailing stop, performance is significantly worse. And then if you move it to that 50%, it's still not quite as good. I mean, it's very similar to the current, but none of these could get past it. And so, without any other changes, I would say that's not the thing to do. And but I think hopefully what you're seeing through this exercise is that there are different ways to analyze a quantitative system. I mean, you certainly have the raw profit number, but there's a lot of other things you have to consider: the average gain, the drawdown, the win rate. The one thing about all of these that they give you over what we have now is that you do get the emotional win in a sense. So in other words, with all the other ones, for the most part, it's a little bit easier emotionally because instead of just being kind of long that entire day, we would have had a stop that would have been moving. But the dilemma, though, is that really worth the profits, though, that you're missing out on? And some might say yes, but I know a lot of you would say no. And so I think one thing that I am considering is I've mentioned it before, but offering kind of a Phoenix Light kind of version of this algo that would take into account some of this maybe, and I would just be clear that there is that the returns are not going to be as good, but emotionally it might be a little bit easier for some of you. But honestly, if somebody wasn't looking at the day-to-day fluctuations, they might not even realize it. I mean, at the end of the week, we still closed up, even though the S&P was down slightly for the week. But there is one thing here that is sort of glaring in our face, and that's this high target 3,000. So I wanted to look a little bit closer at this with you and show you kind of the next thing that I did as I was analyzing it. And this, for those of you that are interested in quantitative trade, I mean, this kind of shows you some of the methodology that I use. So I'll start with this kind of like big kind of shotgun approach at just big numbers. And if I see something that looks like it might be promising, then I might take it to the next kind of step. And that's what this shows here. And I know that it's hard to see. You probably can't see these numbers, or maybe that you can, but they're a little blurry. But basically what this shows is the TradeStation report, where you take the high target and you say, okay, well, what's the optimal then? And what it does is it starts with a $200 target and it goes all the way up to a $5,000 target on $200 increments. That's what this is showing. And the number that TradeStation picked when it was all done was $3,200 is the high target that it thinks is optimal. But what you'll kind of notice is that this is a classic thing where there's an element of curve fitting involved, to where I think we would all agree there's nothing magical about the number 3,200. More what this is helpful at showing is definitely you see an increase in the profitability. If we look at, what's an easy way to look at? The profit factor is one easy way to see it. Notice if it's $200, that's basically that first one, the always for case. Profit factor is 1.17. If it goes to $400, it's 1.22, 1.21, 23, 24, 25, and you can see it going higher. That's exactly what you want to see when you do this kind of thing, is that there's a pattern that's consistent and kind of makes sense. And in this case, the larger the target, the better. And so then the only question is, should we use a $3,200 target or not? My argument would be no, that when you really look at it, it's going to find the highest number, and there's going to be some number, but you got to think of it as like a big cloud of fuzziness around that number that you want to say, okay, if I go down 10 levels, is it good? And if I go up 10 levels, is it good? And make sure that you're kind of centered in between what looks like to be really good results, which is why you need to have a consistent flow as the variable changes, in this case the high target, that you see it consistently get better. But then, yeah, I mean, you do hit a limit where the higher you go, it doesn't really affect it much, but that's just a function of the specific cases that occurred in the past. I mean, who's to say that there's not going to be some day out there where it does rally to like a $6,000 gain, and it goes past this? Well, then if we were to do the back test, it would clearly show the 6,000. So again, the point is not that we can find the perfect number for our target, but that we're staying consistent with what the model says we should do, which is have a high target. The bigger the target, the better. And so in our case, all we're doing is we just don't have a target. Or you could think of it as we have a target, but it's really big. It's like $10,000 or something like that. But yeah, so hopefully that makes sense. I know this video has been a lot longer, But keep in mind the disclaimer on the below. This is for the back-tested results. So, but I think you guys are all aware of that, and I've showed that all over the website. So, yeah, just keep that rule in mind. If anyone's looking at these and thinking those are the exact numbers that we saw, they're not. I mean, this is a sim kind of back test. But the point of me doing this was to talk about this kind of day that we had in the middle of the week. I know it's hard when it goes up and then sells off and then goes up, and we kind of get out with a decent gain, but nothing earth-shattering. Well, I mainly wanted to show you guys that this is the reason why we do what we do. And hindsight is always going to be 20/20. There is no crystal ball. Even if we had $1,000 target on this and we got out up here, that doesn't mean every time it will. There's going to be times where it won't. And so what we have to do is just stick with what the data says we should do. And at this point, I'm convinced that not having a target is the best thing to do. But I'm always open to exploring other ideas and other ways that this momentum S&P algo can trade. But overall, though, this week was actually pretty good for us. We added to the gains. This momentum S&P algorithm has had 13 back-to-back winners now. I mean, we added another 2 this week. The 10-year note trade that we're in is up. So it's been a good week. April's been really good for us as well. And if you watch the other 2 videos, you'll see that we're actually up a fairly large amount in April so far. And we do have about another week left, so we'll see how we finally close it out. But mainly I wanted to show you all the trades and then do a little bit deeper analysis into this kind of thing, because I did get a few questions from people asking very legitimate, good intention questions of how come we didn't get out when it was up, or why did we let a winner almost turn into a loser for us. It didn't. Again, we got out with a small gain. But we did, we came close to getting stopped out, but we didn't. Well, the reason why, though, I guess I'm repeating myself now, but if you have a break-even target on there or something that moves to break-even, the performance is worse. And so, why would we do that? I mean, yes, there's an emotional win, but I don't think that is worth the difference here. The 50% one, that gets a little closer for sure, and that's one that I'm definitely open to explore, and I'm going to look a little closer at a few other ways that we could maybe handle that. But it is a long process with quantitative trading. I mean, once you have something that tends to be doing good, the worst thing you can do is go and interrupt it just based off of one trade. This is a long, you have to take the long game with the algorithms and remind yourself that there will be days that we're up, there'll be days that we're down, there'll be weeks, where we're up. I mean, it's just the normal ebb and flow of it. And the less that you look at it throughout the day, in a lot of ways, the better. But, I understand it's your money, and I definitely don't blame people for doing that. But there's an emotional side to this, as you know, that can be tricky. It's certainly exciting when we get a winning trade and when it's up a lot. But when we take losses, that's never fun for anyone. Or when we give back big gains. But again, overall the week was good, and I'm optimistic about the next week for sure. I do think that. I really do think that we'll close out April strong, that we'll even add to these gains. Just remember, though, there's no guarantees in trading. There's substantial risk of loss in trading futures. It's just not for everyone. And, of course, I'm not a CTA. We're a third-party developer, and these algorithms are traded under a letter of direction. So I think with that, I'll go ahead and close out the webinar. But thanks again, everybody, and I hope you have a great weekend. And, we'll be in touch this time next week. Thank you. Bye.